Right now, in the middle of the year, there's a set of tax moves quietly available to you that disappear the second the calendar flips to January. And most people never hear about a single one of them because the person they pay to handle their taxes only shows up in spring. And by then, it's a history report. The moves are gone. We've spent decades sitting across the table from families in exactly your spot. Let us show you the ones you can actually still make today and the single move that quietly matters most.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. Here's the thing almost nobody says out loud. Tax planning and tax preparation are two completely different jobs. Your accountant in March is doing tax preparation, reporting what already happened after the year is closed and the IRS has shut the books. Tax planning happens now, while the year is still open and you can still change the outcome. And the families who pay the least over a lifetime aren't the ones with the fanciest accountant. They're the ones who started early.
And it's not really about shrinking this year's tax bill. It's about lowering your lifetime income tax bill, a completely different game. A lot of successful families have no idea what bracket they're even in right now or where they'll land by December. And if you don't know that, you can't plan. So move one is simply this. Get a clear read on your tax picture now while there's still road left to drive. Let us give you the most personal example we have. Our dad did this. He spent decades thinking 10 and 15 and 20 years ahead on taxes, always planning, never just reporting. And then in 2019, he died. And the next year, on roughly the same income, our mom's tax bill nearly doubled. Not because anything went wrong, that's just how the code is built. The year after a spouse dies, the survivor often gets pushed into a far less forgiving tax situation. Same money, far bigger tax bill. But Dad planned for it. Had he not, that number would have been dramatically worse. One person thought ahead and it protected the person he loved the most. That's the whole idea behind everything we're talking about today and what we're going to show you.
Move 2, the one people miss the most. Roth conversions, time to the year. Most people think a Roth conversion is something you'll do someday, but the openings show up during the year, and then they close. For example, if the market dips, and there's a dip somewhere in almost every year, converting while values are temporarily down means you move the same investment for a smaller tax bill.
Let's make that concrete. Say you've got 1,000 shares of $100 stock that you want to convert. If you convert it today at $100, you pay tax on $100,000. But let's say it dips to $80 a share. Now you convert the exact same shares, same company, same ownership, same future, and you only pay tax on $80,000. And if the stock were to recover after that, all of it happens in a tax-free account inside the Roth, instead of a tax-deferred where the IRS is still your partner. You're never going to catch the bottom. Nobody ever does. But being aware during the year, instead of finding out in April that the window came and went, that's the whole difference.
And we'll say this part gently because it's a hard one. There are moments in a year when a conversion suddenly makes far more sense. If you retire mid-year, your income for that year is often much lower. That's an opening. And if you lose a spouse during the year, while it's the last thing on your mind, that's often the final year you'll file jointly. We raise it not to be grim, but because nobody else will. And it's exactly the kind of thing that gets missed when no one's looking ahead.
Quick note, because this is the whole reason we make these videos. Most financial content tells you what you already know. We'd rather show you the moves that usually only get talked about behind closed doors with families who are working on the entire financial wealth picture. And there's a whole set of these we're not going to cram in today. The distribution moves, the ones around required minimum distributions, filling your lower brackets before the government forces you to. That's its own set of videos. If you want us to take you there, subscribe. You'll see that video or those videos when they drop.
Move 3, capital gains and losses, and the one almost everyone forgets they have. Sometime mid-year, look at your portfolio, see where it actually sits, and ask, does it make sense to take some gains now? To realize some losses? We don't want this to become a market timing thing. All any of us know is where things sit today. The point is to be intentional about which transactions you make and when.
And here's the forgotten one. Tax loss carry forwards. If you took losses in a rough stretch years ago, those losses don't vanish. They get carried forward until you use them. Most people slowly burn them at $3,000 a year and never think about it. But you can take strategic gains and offset them against those carried forward losses. Sometimes paying little or nothing in capital gains that you needed to take anyway. Maybe to rebalance a portfolio that's drifted. It could be a number of things. That's money sitting on the table. The people who grab it are simply the ones who look.
Move 4. If you give to charity, and a lot of families like yours do, because giving back is just part of who they are, give the smart way. Here's what wealthier families almost never do: write a check. Cash is the least efficient way to give. Instead, they give appreciated stock, so the gain never gets taxed at all. And once you're old enough, they give straight from an IRA through a qualified charitable distribution, which can satisfy required minimum distributions and keep that income off your return entirely.
Let me tell you about a conversation that captures the whole spirit of this. A woman told us she wanted to leave her church a gift in her will. We asked her one question: have you ever thought about giving it today? And she was just months from being 70 and a half and old enough to give straight from her IRA. Her face changed. She said, I'd love that. Then I get to see exactly what they do with it. And it could be a stained glass window, it could be a new pew, same gift, same cause, but the smart structure meant more reach the church and less reach the IRS. And she got to watch it happen while she was alive to enjoy it. That's the difference between giving and giving well. Now, you might be thinking something right about now. This all sounds like stuff for people with way more money than me. My accountant would have told me if any of it applied.
We hear that. So here's a true story. We were sitting with a client and his wife who had millions in an IRA, talking through converting some to their Roth. Their accountant was there, a man who had done this for decades, actually in his final season before retiring. He asked us, why are you having them convert? We said partly because we think taxes are headed higher, but mostly what happens when one of them dies and the survivor is a single taxpayer with those enormous required minimum distributions. He went quiet. Then he said, wow, I never thought of that.
Decades of experience, a good, smart professional, and it genuinely never crossed his mind because his job was this year's return, not the client's lifetime income tax bill. And that's not a knock on him. That's the whole point. The biggest tax opportunities don't fail because someone's bad at their job. They fall through the cracks between professionals who never talk to each other. And that gap isn't your fault. You were never told it existed. You're not expected to know.
So we'll be straight with you. None of this is magic, and not all of it applies to you. If most of your money is already in Roth accounts, some of these moves do very little. But if the bulk of your savings is sitting in a traditional 401k or IRA, the way it is for most families who did everything right, the gap is real, and it costs you every year you wait.
So here's where this leaves you. A tax return that you do every April is just a historical document. It tells you what already happened after it's too late to change it. Tax planning is about the years ahead. And right now, mid-year, the door's still open. But knowing the moves isn't the same thing as knowing which ones make the most sense to you. So here's the question that should keep you up tonight. Of everything we just covered, which single decision makes the most sense for you and your family? Not today, over a lifetime. Not this April, but over the decades. Because you get that one right, and the rest falls into place. That's the video you should watch next. It shows you exactly how informed people measure this and why your tax refund may be quietly lying to you about how you're really doing. Because investing is the easy part.